Welcome back, members. We welcome you all for the current session on detailed discussion on loans and advances, deposits, and intercorporate loans. We have a well-known speaker, Mr. Thirupal Gorige. So may I request Pramod to escort Mr. Gorige and hand over a flower bouquet to him. Yeah. Members, a small piece of information and introduction of Mr. Thirupal. CS Thirupal is a partner of Thirupal Gorige and Associates LLP, a company secretary firm in Bangalore, dealing in various corporate law practices. He is a BCom graduate from Venkateshwara University, Tirupur since 1996 and a fellow member of Institute of Company Secretaries of India. He has qualified in the year 2001. He was associated as a full-time company secretary in listed and unlisted companies till July 2004. He then started his practices in the year 2004, August, for rendering secretarial, management, financial, taxation, and corporate law services in various corporate clients and other entities. He is an insolvency professional registered with IBC. He appears regularly on various authorities like NCLT, or Register of Companies, Official Liquidator, Reserve Bank of India. He is one of the core resource person of Blue Book of ICSI Premier on Company Law Volume 1 and 2, Contemporary on Companies Act 2013, released by ICSI, New Delhi. He was also one of the research member of the Company Law Research Team constituted by the Center for Corporate Governance and Research and Training by ICSI Mumbai in the year 2018. He has been a speaker at various firms. He has conducted workshops and seminars organized by various institutions and organizations, which of them could be ICSI, ICAI, ICWI, IIBM, and Institute of Directors. I present here before you, Mr. Tirumala and Gorige. Thank you, sir. The dais is yours.
Thank you, sir, for introduction and providing opportunity to rather sharing, enriching my knowledge. I hope our session will be interactive. So you can stop me any point of time. So I focus on journey rather destination because we don't know how long we know when we'll reach the destination. So today we don't know whether we are able to complete entire slides of my PPT, but whatever you study or whatever we learn, let us have a clarity in it. So my idea is there to focus on journey, not on the destination. So with this, I hope you guys be, in fact, the concept what we have today is on loans and advances, deposits and intercorporate. We are only theory of this subject being a company secretary, but you are practice. So you must be having a lot of queries and also you must be having a lot of, issues. So let us discuss all those things, whatever it is, let us, try to analyze and try to comply the law in spirit and letter. So with this background, I'll just move on to my PPT. So as I told you, if you have any doubt, let us discuss then and then. So I heard most of the times, last 5 minutes is awarded, allocated only for the question answer session. You will hardly get any question answered. So let us have the, session completely with the question answer mode. So I'm happy to, interact with you, and wherever possible, I try to clarify it. Yeah, disclaimer, the views are purely based on my knowledge, understanding of law at relevant point of time. So the organizers have no responsibility on my view. And if you want to take any view, go better by expert opinion. And similarly, this PPT was prepared by my team, and any errors are there, I own the responsibility, not my team. And this PPT is not anything like copyright I have. So any part of the PPT, because I just taken from a public source, like a book and all, so you can copy paste, use freely. There's no problem. Yeah, today we are going to have these discussions of, I can say 3 areas we are going to discuss, though there are 4 sections, it appears, 4 chapters. So 3 areas. One is the deposits. You all know that a lot of struggle is there has been there from 2014 onwards once the new Companies Act was pronounced. So you have so many issues with respect to deposits. Now adding to that, they've added, recently, rather I can say 2019 onwards, we are supposed to file a form called DPT. One time was there, then now it is made, yearly once. It is basically like a body scan that you do and hand over to the regulatory. So like jellyfish scanning that you will do, in addition to your balance sheet, you are giving even entry level, at least if not entry level, at least grouping level, we are providing information, breakup of complete heads, around 19 heads as per that particular form DPT3. So they want to have the data bank for further analyzation of compliance or non-compliance. That is the whole idea of DPT3. So we'll discuss each class wise of the DPT3 as well. The next one is all about, I think everyone is fighting, this section 185 redrafted, reintroduce the section. So earlier was draconian till 7th May 2018. After that they modified by entirety it is like old wine only. They put little filters. I will go detail. Then under 185 there is no rule. So they have not prescribed any rule under 185. Earlier some rule was there. The rule is now redundant. Then you have 186 subsection 1. In fact, as far as 186 is concerned, there are 2 concepts, rather 3 concepts are there. 3 clubbed together and made as a 1 section. I think the subsection 1 is alone a policy about how many you can have, especially investment layers, subsidiaries. So web of the subsidiaries is stopped now. You can't go beyond 2 layers in the vertical manner. Beyond that is not allowed. So they want to regulate how to, create subsidiaries beyond 2 layers. They are given some 2 exceptions. One acquiring the foreign companies, and other one acquiring or creating the company due to any law requirement. Suppose you got a project, SPV, like a road project you have, and government says you need to create as SPV. So excluding those circumstances, you cannot create more than 2 investment companies. So we'll discuss on that. The next section, that is subsection 2 onwards, is a different concept altogether. No connection between 1 and 2, except the definition provided to the investment company at the end of the section through explanation. The investment definition is common for both subsection 1 and rest of the sections. So of course, 186, there are rules and regulations, rule 11, 12, 13 of the MBP rules. We'll discuss that also. So again, this is again the section 186 is the section you can't go for a compounding, and imprisonment of 3 years is a mandatory, and penalty also mandatory. So though it is a regulatory section, old section 1956 Act 372A is the replacement to the same section, but the old section was applicable to only public companies and their subsidiaries, whereas in the new section, it is applicable for all companies. So that is the difference. Yeah, overview of the deposit will go through. So as I told, these are sections we are going to discuss today. Few companies, you know that, there is a chapter 5, right, beginning section 73 to 76A, read with the deposit rules, are not applicable for these companies. One is a banking company, because that is regulated by RBI rule, and we have housing company, again it is regulated by the RBI, and then companies specified by CG, till date they have not specified. However, 2 rules, they have specified only certain transactions accepted by or taken by such companies, like example Nidhi company. accepting money from its own members towards the deposit by the needy company is exempted. So through rule they are notified. And one more category like a chit fund company, any subscription for the chit is not considered to be a deposit. So that category of companies notified through the rules, then you know that NBFC has a separate rule. So all other companies excluding these four categories, all other companies are bound to follow the section 73 to 76A and also deposit rules. Yeah, this is the 73(1). 73(1), subsection 1 is a policy for entire chapter. The entire chapter, it says clearly, it is a prohibition technically. It says on or after the commencement of this act, no company, it says no company, that is a negative language, shall invite, accept or renew deposit under this act from the public. That is a very crucial word. The public is not defined anywhere in this act. Nowhere is. Now we don't know what is the mean public. So still open for the situation to interpret. Except in the manner provided under the chapter. So the word no company, that means it includes even a private company. The exception is given, provided under the chapter. Under that chapter including its own subsection 2 also. Because subsection 2 onward, they provide the process how to accept deposits from the members by a private company, members by a company, a public company which is not eligible public company. So there the process is given in the subsection 2 of 73 only. So subsection 1 prohibits the deposit and this is applicable for all companies except the manner provided in the subsection 2 onwards. Subsection 2 provides for the private companies and eligible public, other than eligible companies. Then eligible company, there is a 76 section. So there is a detailed process is there. 73 also speaks about the process also. So what I am trying to tell you, as per the subsection 2, you must have seen private companies accepting money from its members, isn't it, as a deposit. But the requirement is there to pass a resolution. We ignore it. I've seen many companies, they accept money from the members, but the requirement of just ordinary resolution. It is by the shareholders, not by the board. Subsection 2 says clearly. So have a point. Keep in mind that whenever you advise any of your clients or even your company where you work, so you need to say clearly, first we should obtain the shareholders' approval. How you will pass this resolution, whether the resolution is for independent party-wise or resolution is like you say in a financial year, this much I will accept, that is up to you. They left it open. So you can say, I can pass one resolution saying that up to 100% of my paid up capital, pre-reserves and security premium account, I will accept from the members. Pass one resolution. As long as you don't cross that threshold limit, hope that resolution is valid. So each time you don't need to pass. Whenever you accept the money from your members, you don't need to pass a resolution. So a general resolution can be passed, which is an ordinary resolution. No need to file form MGT 14 with ROC. It is internal. It can be passed either at EGM or AGM. So have the resolution passed before you accept any money. The second one, that is that resolution is required for private company, public company, and also eligible company if they are accepting from its own members. There is a eligible company that can accept from public, which is an exception to subsection 1. Subsection 1 said clearly no company can accept except the manner provided. So 76 says clearly eligible public limited company. I feel hardly any company after Companies Act 2013, going for this particular 76A as a eligible public limited company. Very, I think hardly some 5-6 companies. I heard Tanishq had gone, that is a Tata's company, had gone with this concept of 76 one, and there they are supposed to pass some special resolution. So here it is written public company. What is the eligible public limited company? It is a public company having 100 crores net worth or turnover of 500 crores. They are eligible to accept the public deposits, wherein they can advertise in the newspaper they can go up to around 35% of their paid up capital free reserves, depending upon the size. So only that company, today I'm not going to discuss on that particular, because very few companies, you have total active 13 lakhs companies are there. Out of that, 75,000 companies are there, only publicly limited companies. Out of that, hardly 100 companies, they used to accept the public deposit earlier. Now the new Companies Act 76A, draconian, penal provisions are there. Due to that, very few companies are going. So that I'm not going to discuss today about the public company process. Seems it is a futile effort, not required much to discuss. So I'm not getting into that. Now look at this definition. It is there in the class 31 of section 2, and also same definition, extended in the form of rules 2(1)(c). What it says, receipt of money, and definition, it is inclusive definition. You must be aware of inclusive definition, anything can be added, which is, matching with the parameters of the definition. So in general, inclusive definitions are definitions providing examples to and make the concept to understand. They are the only examples. They don't provide any, meaning, exact meaning. They provide some examples like this is this, this is this, that's all. You need to understand what will count. And here look at this, any receipt of money, you call it as a deposit, or you call it as a loan, or you call it any other form. Any other form, why it has come? Like you see the 2(1)(c) rule, there are 19 transactions. They are given while telling 19 transactions, they said that subject to these conditions. Like you have share application money, they say within 60 days, if you are going to allot the shares, or if you don't allot in next 15 days, you refund the money, then it is not considered to be deposit. But if you don't satisfy those two conditions, then it will be deposit, like any other form. So it is considered to be deposit. Once it is considered to deposit, the next will be the penal provisions. Penal provisions are triggered. That is the reason that any other form means there is a money, but you don't call it as deposit, don't call it as a loan. Receipt of money should be there. Like one best example I will tell you. Sometimes like company comes to us to increase the authorized share capital. And they say, sir, please pay the money, I will reimburse it. So consultant or the chartered accountant or company secretary who is filing the form for SS7, and he uses his credit card and amount is paid to the government. Whether it is considered to be receipt of money by the company, whether it amounts to a deposit or a loan. There is no receipt of money, you don't receive the money. So technically it is not a deposit. It is not a deposit, it won't qualify as a deposit. So that means any credit sales is not a deposit. Okay, that we should keep in mind. Credit sales are not deposits. Okay, here also you gave credit to them, is not a deposit. And certain categories, which I told there are 19 categories in the rule 2(1)(c), they are defined, saying that these are not deposits. Excluding those 19, all other things may fall into deposit. It will be deposit, and accordingly you will be governed by the law, which is a draconian. Section 76A is very draconian. So you are governed by that penal provisions. Okay. So then coming to the 2(1)(c), that is a rule. Rule also says same definition. Any receipt of money by way of deposit or loan or any other form by a company, but doesn't include even you accept from public. Even you receive that particular money from public, if you satisfy those 19 criterias, then it is not a deposit. Okay. So we'll go to the detailed analysis of each clause. Yeah. Why they allowed this 2(1)(c) rule? So many exemptions. They have taken some categories. Let us exempt the companies. One is the business transactions. So they say all business transactions are not deposit. There is a receipt of money, so we should not consider as a deposit. Then capital nature of transactions. Suppose you give an advance, or you take an advance for capital goods, or you take like real estate company, they take money for supply construction of flat, or the flat will be given after 365 days or whatever it is, but it is a capital good. So there is an exemption given, like 5 years, all those things are allowed. Like fund management purpose between companies, it is allowed now. See, if you look at the exemption rule, it says any company from money from any company by any company is exempted, is not a deposit. Even you call as intercorporate deposit, but as per the definition, it is an exempted category. Any money from any company, any money. The word used will deliberate on that particular why the any money it is used. Then relatives, they say they want to allow the relatives of the private company to extend the money. Not only directors, the relatives also can extend the money. The reason is that relative, either they know it, how to lose the money, or how to get the recovery also. They know it. That is the reason they say, you can take care of the recovery. I don't want to control you. That is example. That is the objectivity. So for doing business, generally we go to the bank. So any money that you receive from bank is not a deposit. Similarly, any transaction regulated by the FEMA, it may be your own care capital transaction, it may be ECB transaction, it may be right beginning that this one, advance from goods and so many things, services, all are not, as long as you are able to comply with the FEMA, then they are not considered to be deposits because the receipt of money is there, no? That to inclusive definition. And listed, suppose you do certain transaction through listed entities, like you go for NCD listing, that is not a deposit. So as you know why they have left this, if you don't allow the breathing, how you will take breathing? So they have allowed the businessman to breathe with these business transactions. So that is objectivity. Yeah. So certain transactions which now we will deliberate all 19 transactions, which we are, I think, filing the DPT3, which I told you know, all 19 transactions, DPT3, we need to provide outstanding balances as on the balance sheet date. I think this month is the last date. June 30th is the last date to file. Whether you have audit or not, believe me, whether you have audit or not, you have to file this DPT3 based on the provisional balance sheets. As far as the deposits are concerned, you have accepted deposit being a private company from its members, then there should have been some auditor certificate for that. Not audit of the companies. Only auditor should certify these figures from the so and so records. Outstanding figures accepted from the public. So there is auditor certificate is there, not audit of the company as such. See, generally by June you don't get audit, no? So you don't wait for the audit and all, but get a certificate from auditor of the company and file that DPT return, 3 return with the deposits of the company. Deposit taken from the members. Deposit taken from members only will fall into that category. But these 19 transactions purpose you file DPT3, there is no auditor certificate. You go with the provisional balance sheet and file accordingly. There is no problem. So one of that category, 19 category, any government receipt of from government or guaranteed with the government, it may be state, central government, local authority, statutory authority, that money is not a deposit. Similarly, any money, as I told you, anything that you expect from the foreign, anything in compliance with the FEMA, but you should comply with the FEMA. Then it is exempted here. Similarly, banking company, you all know, it may be a facility, it may be a loan. Both means the fund and non-fund basis are not considered to be deposits. So both are covered under this rule. Similarly, public financial institution, you can take it from them also, like KSFC, you can take the loan. There is no problem. Similarly, commercial papers. So this was the concept earlier. Now I don't think anyone is using. Or any other instrument you do as per the RBI guideline. You raise the money as per RBI guideline. That is an exempted deposit. The sixth one, very liberal interpretation should be made. It is written clearly, any amount received from other company. So what I'm trying to say, these all 19 exemption individual clauses. So these are 19. So 19 caps are there. As long as you are able to wear any cap over, that is exempted. Because this is an exemption section. You all know that, income tax, if there is an exemption is given, benefit or doubt to be given whom? To the intended, whom it is exemption is intended to be passed on to him, benefit of doubt. Here also, like 360, we are reading the two clauses. One is that supply of goods and services you have received in advance. 365 days they have written. They have not written from whom. I presume it is from public. If you have taken money from public and 365 days is passed, then only it will become deposit. But if I take from the money from another company as an advance for supply of goods and services, it is not a deposit, even it crossed 365 days. So out of 19 clauses, any clause, if you are satisfying over that cap, now how will interpret? Tell me. They are given very plain vanilla color. They didn't give any color for this class 6. Any money received from other company. Any money. Is there any color for that? How will interpret any money? It can be a share application. It can be even a deposit. It can be a what is that, NCD amount, or it can be even, what is that, customer advances, anything for that matter. They want to cover the very, very plain vanilla language called any money from any company. The whole object is that other company is not a public. The public word is not defined. No, did they define public anywhere? They didn't define. It is assumed that a company is giving money to other company. The company is regulated by a board of directors, and they take all precautions. It is not a weaker section. See, the whole object of the deposit rule is to protect the person who is giving the money, being a weaker section. He doesn't know what is happening in the company. So they want to protect them. The objectivity of the deposit rule is to protect the public from general. Here, when money is being accepted from another company will certainly take all precautions. When it is going to be repaid, is it secured money, whether it is properly, constituted, all those things they look into. Even they put the end use conditions also. So company relation between two companies, it is presumed that they are happening at arm's length, and they have all sorts of freedom to control the transaction. That is the reason is left open. Yeah, please. Of course. Yeah, the word company, again, you should go to the, clause 20 of the Companies Act. Clause 20, section 2 of the Companies Act. Company means company incorporated under the present act or any other previous act. See, they should have used the word to cover the thing, body corporate. If the body corporate word is there, they would have got it. I will give another example so that you will remember. LLP cannot give loan to company. You know that? Because it doesn't fall any of these categories. It can give only to the extent of those like 365 days, advance purpose it can give. Similarly, it can give for the capital investment purpose it can give. But under this clause, it cannot give. If LLP gives a loan, it should qualify any other clauses. Then only LLP can give loan. Otherwise, LLP cannot give a loan. I've seen many companies, many people, they pool the money in the form of LLP and they start giving loans to the company. As a loan, they cannot extend. It's not allowed in any of the clauses. It will become a kind of a, what is that, public deposit kind. Because nothing is exempted in 19 clauses. If you don't fall in either of the 19 clauses. So similarly, as my friend said, overseas body corporate, there is a concept of ECB, which is regulated by FEMA. Once you are going to satisfy that condition, no need to worry about deposit rule, because the sub rule 4 of this 2(1)(c) says clearly all FEMA transactions are exempted. But you should satisfy that. If you satisfy, there is no. Only worry about the LLP, which is the Indian body corporate, and it's not covered here. So I don't know, they should extend, instead of saying any company from any other body company, they should say body corporate, then comprehensively it is covered. It's not covered. Other, all know that share application money, earlier it used to be there years together, we say simply share application money without having terms and conditions. Now they want to regulate it. Even your guidance note and the balance sheet says clearly, you should, if you don't have terms and conditions, then you should classify the other than, what is that, other debt, other non-current liability, something should satisfy. Yeah. Yeah, that is a different aspect. Yes, common director, one company can give, other company can take also. There is no problem. As long as you are able to satisfy the other conditions like 185, 186, 179, all those things you should satisfy and you can take it. It is not a deposit. We'll discuss that also because we have a session on that also. So then next one is the director of a company. It is written. That means director of a public company, director of a private company also can give a loan to the company unlimited. unlimited. There is no criteria how much you can take under. There is no. So how much he wants, he can give. Similarly, relative of director of private company. So relative comes only for private limited company. Again, amount is unlimited, but conditions are there. Like he should give the declaration that he has not borrowed money from any other individual. Any other person they have used word. Now how you will interpret the person? See, there are seen the situations are there. Like bank is not ready to give directly loan to the company. Bank says you will pledge your property, I will give loan to you, and you in turn give it to the company. I've seen many banks are putting these kind of conditions. Now the person is not defined. They have used from any other person. It appears to be the individual only you can interpret there. Means provision is there only taking money from other individual and giving money to the company. But if I take a bank loan where it is secured my personal asset, I don't think any problem in it. You can give a declaration clearly stating I have not borrowed from any other individual. However, I borrowed from the bank and given, because it is a precondition of the bank that I should invest money only in the company, and they are ready to give money to me as a loan based on my net worth. I feel that extent you can go and interpret that word person. So you can go ahead. I am not finding any problem in it. Similarly, the declaration should come from the, yeah. No, yeah, please give.
So I know his assets
Yeah.
are significantly less than what the amount of loan which is given.
Hmm.
So in that context, if the director gives a declaration saying that he's not borrowed it,
Yeah.
what responsibility does the company have?
I don't think any, see, the law says clearly one condition. You get a declaration. What do you mean declaration? Someone gives a photostat copy of his own identity, which is not true. How will go and verify? Now, of course, you have EDIN, UDIN, KIDIN, whatever the DINs are there. You go and MCA or in ICA institute and verify whether you are given a certificate or not. But there is no such public place where you can verify the data. I feel one should rely on the self-declarations, because the self-declaration resume. Even our own income tax are based on the self-assessment taxes only. It is also same way. Up to the director to face the music tomorrow. If something is unable to prove to the regulatory like ROC or income tax, then he should face the music. We didn't make him to give a wrong declaration, no, isn't it? So you rely on the declaration. I don't think you don't need any background check and all, because the law is not asking you why you need to do. Is the question. So similarly, once you get the money, there are certain disclosures you should make. One is that you should make in the board report clearly that you have borrowed this money from the the directors and his relative. Similarly, at the notes on accounts also you should provide the declaration. Then DPT3 also should be filed. What I found in so many balance sheets that these declarations are missing. Now ROC is sending notices. Okay, the law permits you to accept it, but you didn't disclose also. You didn't disclose, that is a violation. For disclosure of, non-disclosure also same penalty is the problem. So ROC is hitting with the same stick. 76A is very, very draconian section. So please ensure that the disclosures are made. If you look at the now revised, I can say amended schedule 3, read with your own caro, lot of disclosures. Hell lot of, means entire, you are giving entire tally backup, including your agreement, signing, this, everything to the ROC. Correct? No. Now look at, I will give an example like you were having a transaction with a company which got closed by the ROC. Now they are asking how much money you owe or how much money you should get from that company. Give the details of the company. One company has approached me having 300, vendors. Now 300 vendors, they are saying you please verify at MC and give me a statement that these companies are not under strike up list. So that extent now disclosures are required. Now tell me the one more requirement as per CARO as well as the certificate, like charges were created but not filed with ROC within 120 days, which is a mandate requirement. I will tell you why this has come. Now you know all the IBC, Insolvency Bankruptcy Code, it is for last 5-6 years is on. So people started creating backdated charges on their own assets, especially the promoter they started creating. to stop them backdated entries, what they will do, they file the backdated charge document and go to the RD office and get it validated. To stop that only for IBC sake, now they given only 120 days time. All charges, if you not filed with ROC, you can't file. Now in the new schedule and also your CARO report, you are supposed to validate company has created charges and not filed with ROC with 120 days. These are the charge details you should provide. And you should validate also. I will tell you, now there is no exception from filing the charges. Earlier in the old act, we were taking all types of, one was the only exception was the pledge of the any document. Pledge means you placed it and got the money. In the new act, that also is chargeable. That also fileable. You should file it. Nothing that I've seen, many companies are not coming forward for vehicle loans. Now, this year balance sheet should speak all those vehicle loans which are not filed with ROC. You need to speak. Go and see your CARO and also the Schedule 3 amendment. You need to disclose those details. ROC wants to have the culprits. What are the cases? Because those filings or non-filings will make those charges are unsecured. Yeah, it will become unsecured. If you look at the 77 provision at the last proviso, they say clearly void. If not registered, it is void at the time of liquidation against the liquidator. Liquidator will not accept you. But during the lifetime, you cannot come to the under Companies Act and file a case for recovery, but you can go to common law, go to the regular court and file a suit. But if company goes to the liquidation, means including IBC, IRP, RP liquidator will not recognize you. Will not recognize you as a secured holder. Will not. And you see where the waterfall, if you are not a secured creditors, out of 8 people in the queue, you will fall, drop from the 2nd zone to the 4th zone, being a financial creditor. So very, very crucial. All banks, attitude is there, especially vehicle loans. The guy who is handling it doesn't know anything about Companies Act. Simply say, we don't need to file. So this year onwards, we are going to give a scanned report of all the charges to the ROC. ROC will go behind us, invoke the section 87. 87, if you go and see, the penal action is there if you don't satisfy the charge chapter. Similarly, you have taken the loan but not disclosed in the board report, not disclosed in the financial statement from the director, they will invoke the 76A by the ROC. 76A, I told, no, very draconian section. So very careful about it. Then again, secured bonds or debentures, it is obligation of the company as per Companies Act section 77, not the financial person. Also, if company doesn't file within 30 days, he can also go and file. But fortunate or unfortunate, without signature of the company or without signature of the charge holder, no one can file the form. So ultimately, even if you want to file also, the charge holder should sign the document. System should have been enabled in the first field itself. I am filing because company has not filed the document till date. As a charge holder, I am filing. Then with my own signature, the document should be allowed to be loaded. But system is not designed in line with the provisions of the act. So that is a problem. So company only should file. As per as the creation, modification, both have got. What company has an obligation, the charge holder has a right. Whereas in case of satisfaction, only company has obligation, not the charge holder, to inform the satisfaction. And that too, 300 days you can file. In case of satisfaction, 300 days, no need to go to RD for condonation, you can file it. But again, it is an obligation of the company only. The charge holder has nothing to do with the satisfaction. And after 300 days also, still you can file and go for a condonation. Unlimited period is allowed still. Similarly, now go to the secured bonds and debenture. If you are going to issue a secured debenture or bonds to the public also, it is not a deposit, but security should be as a first charge on the scheduled assets. That's how they use scheduled tangible assets. Schedule 3, wherever you have Schedule 3 in the tangible assets, that means intangible assets cannot be given as a security for the securing the bond or debenture. So there is another category is there, convertible. Compulsorily convertible bonds or debentures can be issued under this rule and still cannot be considered, it doesn't amount to be a deposit. Okay, that is the one. Then NCD. So if it is listed at the stock exchange, any recognized stock exchange, privately placed NCDs listed at any of the stock exchange is not a deposit. Then you have any money received from the employee as an annual, not exceeding to his annual salary as a security. Like you know that gold companies. Gold companies, the employees are supposed to deal lot of, gold or precious metal here and there, handling will be there. Generally, they take the deposit as a security deposit to recover the any loss or the embezzlement, all those stuff. So that is the up to 12 months only you are allowed to take it. This is the one very crucial. People are also arguing different. Earlier the word was or, now they made it and. It is written, any non-interest bearing amount received and held in trust. Non-interest bearing amount held in trust. Held in trust, what do you mean trust? Is not your money. Someone has given some 1,000 rupees, please hold. So he is getting down into the water. He says, you hold it 1,000 rupees. Okay. Let me go back to the water and come back. So is it your money? Only those nature of transactions only will fall into this category. But I found many interpretations saying that any money that you receive, if you don't pay the interest, then it is qualifying under this class. That is not correct interpretation. Earlier the word or was there. People used to take interpretation, but now finally they repaired the section, putting and. I mean, both conditions should be satisfied. One is the interest should not be there. Other one, the money should be held in trust. Another one, this is a very, 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 very casual. You will get those kind of like goods and service. You have 365 days. For Indian, for me, I told clearly, if you take from the partnership firms, individuals or any other, means other than a company, only this clause is applicable. Please bear in mind. So in all these clauses, invariably there is a concept called public, because this subsection 1 prohibits only from public. Like other company, any money is accepted. So that is the reason in all classes, any money that you have received towards the supply of goods and service from another company, it won't fall here, is my interpretation. Because the whole section objectivity is to prohibit the acceptance of money in any other different routes from public. So here, this is the one. Again, suppose you all know that even in FEMA also, any advance that you receive from a parent company, you are supposed to adjust in 365 days. If you are not able to go to the authorized dealer and get the permission, and you can do it, that is allowed. The 365 days is not applicable because you are satisfying the FEMA conditions. So here is falling individual and partnership firms, trust or whatever it is, wherever you accept the money, only those non-regulated sectors only covered here. Similarly, movable property, you take the money as a security, like suppose rent advance you take. Yeah, please. Yeah. 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 No, that you can't keep. No, that's what is written. Advance is not security advance. See what you need to do. You should make an attempt to refund it. You should have proof that you made an attempt to refund it. It doesn't come, is not traceable, then you should put a category called a suspension amount, something like that. You should have made an attempt. One is to adjust your invoice. If not, then you go with the refunding. No other exception. They have given one exception, is that if there is a legal dispute, both have gone to court. So supply of goods, quality of goods, whatever it is, they have just gone to the court and you didn't adjust that money. It is allowed. Till the case law is there, it is allowed. Yeah. It is under this same category only, but you should have the proof that you made an attempt to. Like example, your income tax, that what we'll do generally, you claim some bad debts. And income tax officer comes clearly, boss, have you made an attempt to recover the money? What is the proof that simply writing off will you allow? Same way ROC also will question, he will grill you that, boss, you provide me that, why you are not refunded? You say that, sir, I've sent the mail. I tried to send the money to his own bank account, which from where we got it, the bank account is no more, is something. Should prove it. Yes, it is allowed. Exceptions will be there, but you should have a fact to prove that, yes, I made an attempt, I could not recover, send the money out. It's okay. I've seen many cases like foreign, one of my client case, for last 6 years, the money we are unable to send. They are given to the capital goods exporter. Now that company, we learned, the company went to liquidation. And we declared, after making an attempt to the income tax, like writing off the payable. And we paid tax also on that. Whatever the tax liability is there, we declared clearly, this is. So those things you can, if you have a proof. I will give you one more example. Company went into CIRP process. And you have recognized some advance, they have recognized as expenditure, it gone. Now we did not come to the notice of the RP and IRP. RP did not ask me. Meantime, company went to liquidation. What you will do? Tell me. You should recognize as your liability. Yes, your case 365 days is crossing, the person is not traceable, and you made an attempt to recover the, pay the money. Certainly you should write it off and recognize your P&L account as other income. That is the one you have to do. Whenever he comes back, again reverse the entry. That's all. Maybe the issue with GST may come. Yeah. Yeah. Correct. Yes. Yes. Yeah. Yeah. 40 lakhs. 40 lakhs. Whatever is adjusted, you should not be considered. Yes, sir. Please. Yeah. Trust. See, held in trust is something like, if you use the money, I will give one best example. Like earlier, before PF Act comes, you can have your own trust, PF money, keep the money into trust and reinvest this and all is permitted. Okay, here also, maybe similar kind. It's not your money and you are doing a duty of a trustee. And if you are using, ultimately, nowadays everything is happened because of that only. One is, I will tell you two examples of the, one is that leave encashment. It should not be used technically. You should invest somewhere where you earn some interest, which will be equivalent to the interest that should be payable. Leave encashment. Another one, gratuity. Of course, if you have gone to the extent of policy and all, there is no problem. You are not gone. You are just simply going to the actuarial and getting his value and then charging your P&L account that actuarial value and keeping in the asset side. The money you are using. I've seen all CIRP companies, the first money was hit only that. No money. Now, after that, even in the NCLAT also, they told clearly, the first person before the secured creditor gets money, these are the employees should get if there are anything like this. One is the leave encashment and gratuity, PF, ESI. You have made a provision. Okay, and you used the money because the using is not prohibited. So their money, first they should get before secured credit. Even recently SBI has sold the asset to recover under section 52 of IBC because secured creditor recover. Immediately PF authority filed a case against the SBI saying that please give me the money from that. The secured asset before he adjust his payables, he should park the money payable to the employees. There was judgment of Supreme Court. So there they said clearly, yes, PF authority will get priority over any other because in the society, among those stakeholders in the IBC or in the company, the workers are the weaker section. The law only should protect, not the contract can protect. That is the whole idea. So law should protect. Contract cannot protect. Contract means employee contract because he needs job. Wherever he wants, he will sign. I've seen all these, especially garment companies. Every 4 years, 4 months, they will ask all employees to resign massively. After one day, again they release one more appointment to avoid the gratuity. You know that? 4 years, 4 months. For them, nothing, no. They simply sign wherever they want. They say that for them, they are getting employment. But to avoid the gratuity, but continuation of employment 4 years, 6 months, no, you should provide. They don't want to provide. People are doing, that is a contract. Can I say, sir, they have signed and they have agreed also? Means that is, you have exploited the law. So government will come, or the law, the court will come and protect you. In your case also held in trust, whether you can use or not is up to you decide. If you are able to use it, but there should be money that is available. Yeah. Next, long-term receipt, supply of goods. So any advance for long-term project of supply of goods other than immovable property also, there is no time frame they are given, so you can hold it. And future consideration, suppose there is a warranty, you collect today only the money. Like if you buy a car, no, they say 2 years, 3 years warranty, but they collect the warranty period also. The fees, your cost includes warranty period fees also. Now they will park it, that money. How long they can park? Means they can park 5 years they are given, or the warranty period, maximum 3 years. So during that year, they should write it off, or they should adjust or render the service. Yeah, any money received again the sectorial regulatories. So there are some advances, like earlier I know that Technology Development Authority used to give some loan for the software companies. So those regulatories money also is not a deposit. Subscription to the any electronic print media. You know that. So you must have seen some magazines, 20-year subscription you can give in advance, isn't it? You give a 20-year subscription or lifetime subscription. But how they will account? Should more than 365 days is a public deposit, so they are exempting. No, there is no public deposit. It is subscription money. It is a subscription money for the unlimited period you can have. There is no problem. Yeah, this is again as a stipulation laid down by the project financing, the financial institution. The promoter can bring their money. Relatives also can bring their margin money. So there is no problem. And Nidhi company, as I told you, Nidhi company whole object is to take the deposits and give the loans to their own members. Because of that, it is exempted. So Nidhi company can accept from public who are their members. So public unlimited amount. Even the public here, sorry, in the members here, you say maximum public limited private company up to 100%. That 100% is not applicable for the Nidhi company. But they say Nidhi companies should accept as per the Nidhi rules made under section 406. So there is a separate set of rule for regulation of Nidhi company. Once you comply that, here there is no problem. So however, since it is there in the out of 19 clauses, there is one question whether DPT3 should be filed. Because for all 19 transactions, we are filing DPT3 saying the transactions not considered to be deposits. So Nidhi also is there. Should we need to file the DPT3 or not by the Nidhi company? Answer seems to be yes. They also some bulkly should pay. While they may be having other conditions also, other transactions in addition to the public money, they may have other conditions. So Nidhi companies. Similar chit fund company subscription, as I told you, it is not. Then any collective investment, as per SEBI, there is a concept of collective investment scheme. So people can collect the money and they in turn invest. A lot of bubbles were there. You know that plantation companies, they were doing the same collective investment. So that should be registered with SEBI. If they are registered with SEBI, then that is not considered to be a deposit accepting. But they should register with section 12 under the SEBI Act. And similarly, startup companies. So one should have a not startup means what they call themselves is not startup. You must have seen all companies nowadays, especially in Bangalore, is a startup hub. Everyone themselves they call startup. But here the startup company means DIPP, Department of Industry Policy Promotion, Internal Trade. They must have given a license called startup. Those companies can accept the money from a public who is not your member, who is not your director, who is not a relative of director, at a tranche wise or a single installment not less than 25 lakhs. 25 lakhs should be accepted from him. Okay, that they can say it is a convertible note, not convertible security. The note, they say note. There is RBI guideline also on this. This convertible note will be recognized in the books as a debt initially for 10 years, and an option is given to the person who had given the money. After seeing my performance during the 10 years time, he may ask me to convert that into equity. If he doesn't, I should refund it. All terms, conditions like payment of interest, all those things are mutually agreed. So that is not regulated. Only they said tenure is regulated up to 10 years. Second condition, the company should have been a startup company, and maximum 10 years during the lifetime of startup only this money can be accepted. 25 lakhs in each installment. Suppose he is bringing lot of installment, ensure every installment is 25. This money can be accepted even from foreigner also. All individuals, Indian, outside, foreign, everything, everyone can give it. You can account it as a convertible note. There is no problem. Up to 10 years. There are other investment companies like AIF, Alternate Investment Fund, Domestic Mutual Capital, Infrastructure Fund, then what is the REIT is there, mutual funds. All those people can accept the money as their business is like that, or accepting money on their business. Since they are regulated by the SEBI and other regulatories, so here this rule they don't need to satisfy. Here is the one, funny thing. See, at the end of the rule, in fact, this was under the rule 18, I think, not 18, 15. Under the rule 15, that was the last clause was there when the rule originally was there. And in between, they have added 3-4 clauses. Unfortunately, they have added clauses after the explanation. So it appears to be this explanation is only for that particular 15 clause. It's not so. This explanation is there. All gold companies, they are taking this explanation. I think you must have seen, what is that, Lalita Jewelries, owner is coming. You put 11 months, you take the money. Either money you take or you want to have a gold, you round the shop, get the price, lowest price, you take all those things advertisement is making, How? Look at this. This is the explanation given which is applicable for all 19 classes, not for any subclass, but it is inserted. If you go to the deposit rule, it is inserted in between because the additions were made subsequent to the explanation, which is the fault of the notification. So this explanation comes at the end. It's written. So received by the money for the purpose of this clause, that is for entire 21C clause, any amount received by the company, whether in form of installments or otherwise from a person with promise or offer to give returns, means I will pay back you. Return, see again return is return, though you can give back money. That means here you can accept the money. 11 months deposits are allowed. It appears to be directly. This says give offer to return in cash or in kind on the completion of the period specified in the promise or offer or earlier, accounted in the any manner whatsoever. Means you account whatever you want. You say it is an advance for gold purchase. You give the money. I say, boss, today you have given money. Today I will buy a gold at this price only. But you collect the gold at the year end or 11 months end. So all companies, gold companies and any other subscription companies, they are doing this because they are allowed here. And it's written clearly. Any additional contribution also. Suppose 11th month is supposed to be another 10,000 because the gold price may go up. 11 months installment doesn't suffice the maybe 2 grams, 3 gram gold and all. You say, or maybe 10 gram gold. You say, you give me additional money. That money also. So any additional money over and above the amount item A and above made by the company as part of such promise or offer shall be considered as a deposit. Shall be considered as a deposit unless specifically excluded under this class. What is excluded under this class? 365 days excluded, no? That is there for every company, including gold company. So you have to read this explanation in line with the 11A, in line with the 12A, in the line with the 12A where 365 days from public is allowed. So now almost all gold companies are doing this exercise. Up to 11 months they take the money, and at 11 month either give back the money with the interest or they give back the gold, whatever they like it, as per the promise they made it. So it is allowed. So up to 11 months should be 365 days, not beyond that. So all people are going only 11 months because the last 1 month you need to have the breathing space, whether to be given as a gold or given as a cash, what is the interest I should charge. So 1 month they are taking breathing. So they are trying to paying 365 days only. All adjustments are happening. There are some issues are there. Some subscribers may not be available. They would have changed the address. They are not there with you. So many things will be there. There you should face the problem. Because of that problem of not able to adjust within 11 months and 12 months, I heard the Tanishq has gone as a public deposit. They have filed the prospectus like a public deposit. Those money will fall under that category. Public. So no violation. Even if it cross 11 months, no violation. They have filed already. So there is a probability we may skip also. Other side you may not be available, and you don't have any proof to prove that they didn't come to me. And you can't pay also. Now I cannot dispatch the gold. Can I dispatch gold is home? Without seeing the measurement, without seeing the ornament, what he wants. Especially ladies will not allow, isn't it? So what is that? They would have seen some diamond necklace or some necklace at the month 1. After 12 months, they would have changed their mind. So the same diamond, they may not be interested, or the necklace, they will not interested. They say, you add this studs to this and all. So that is the reason he cannot dispatch on his own. So the lady should come, and within 1 month, he should identify which one he want, which stud should be there, whether it should be there, stone or not stone, unstone, all those things should be there. So that is the reason 1 month. So during this process, there is a probability you skip the 11 months or 12 months. So Tanishq went to the public offer. They went for the public issue of public deposits. They have their own website. You will find the advertisement of the public deposits. Yeah, I think we have seen these all. If you don't satisfy those conditions, it will become a deemed deposit. Okay, but deposit, the person who had given the money is not a deposit holder. Whatever the rights that are available under deposit rule are not available to him. He cannot go to NCLT. Because it says deposit or person who accepted, who had placed the money under deposit rule only. Not like this, who has placed money like this is not considered deposit. Recently, one case law before NCLT Bangalore, someone has filed to recover his money advance for the goods, and they didn't pay. Is a proprietor concern. Means proprietor concern has paid against under deposit rule. Then NCLT says, show me under which clause you will fall as a deposit. Deposit holder, yes, your money is deemed to be deposit. It is a legal fiction, but there is no similarity, like you will be considered as a deposit holder. So I am helpless. You go and fight only before the regular court. I can't do. My jurisdiction is not there. So that is a flaw in the system again. So they made the rule to protect the public. Now public is not considered. Only the money is considered a deposit, and they are penalizing as per the 76A, the company and other officers. But the deposit holder should be protected, no? They should have even added one more definition. Deposit holder includes a person who has 365 days is crossed. He is also deposit holder, and he will get all the rights to go before NCLT to protect his interest. That's not there. So these are the transactions. As my friend rightly pointed out, he says if it is more than 365 days, you are not adjusted. Should I need to include in the DPT? As per my understanding, it is an outstanding. It is a deemed deposit, not a transaction. Still, you need to file with a clarification. You should file it. See, these are the things I told you without obtaining. See, director has given the money. Company has not obtained the declaration. Should be filed because it is an outstanding money. They want to have that. Similarly, you issued the debentures and the security given is less than the market value. That's what you're violating. You are violating. You should give, because it is an outstanding, you cannot simply skip in reporting. It is a kind of reporting. You are reporting with a rider. This is already means you are giving your own next scan level report saying that I violated deposit rule also. So it may be self-confession. So that is annual salary. See, the one employee had given some advance to his gold company, and because something he did and you reduced his salary. The deposit is more than the annual salary. What you will do? So refund again. You don't refund within the 365 days for goods or service. Again deposit. So these things should be with a clarification. You should file the deposit rule because that is an outstanding. It may be violated of deposit or transaction. So it is called transaction. 19 transactions they are. If they fall into the deemed deposit category, you should report it. You should not ignore the reporting. See, I told deposit holder, this is I told the member of the company. They say who has given the money, if he is a member, he is to be called as deposit holder. See, any other person, again what happened, deposit, any other person who has made a deposit with a public company, then only is a deposit holder. Member of the company who has given, so you can accept from being a private company from your member, and also public company from your member. So he is a deposit holder. The next person is the person who has actually deposited as per the 76 in the public, that is eligible public company case. But in all other cases, you have 19 transactions. Those 19 transaction person is not a deposit holder, so he has no right to go to NCLT. That is why I would like to convey here. Yeah, these I told you, these are the, three categories of companies I was trying to tell you. So you have private company, it can take only from its members, and I will give you how much it can take. Then public, again, only from its member, it is up to 35% they can take, 35% of paid up capital pre-reserves. Then eligible public limited company, again 35% by giving advertisement here and there they can take. So public eligible, I already discussed this. Private companies. Now is very important to us. See, I may skip, I told you clearly that I may not be in a position to complete my entire PPT, but I am interested only in journey, okay? I may not be interested in completing, rushing through. See, it won't help. See, I did some research, and if I don't share that one, no fun, having the class like this. Let us focus on journey. So the private limited company. So private limited company, there are three types of private limited companies classified in the deposit rule. Rather deposit rule, I can say exemption notification, 5th June 2015, read with 13th June 2017. This exemption notification was modified in 13th June 2017. Now they have classified three types of private limited companies who can accept the money from their members. Their members, they can accept, there is no problem. How much depends upon the category. How much they can accept depending upon the company. So it is written, A says clearly, which accept, a private company which accepts from its members money is not exceeding 100% aggregate paid up capital, and then pre-reserves and security premium account. Here the pre-reserves definition, if you go and see the pre-reserve definition for you guys, I think you should have the clarity under what exactly the pre-reserves is defined under the Companies Act. Pre-reserve, for your surprise, doesn't include the profit and loss account as per the definition. Go and see one more time. Go and see. Pre-reserve, as name suggests, as a reserve, as you all project, as you all display, or as you all, rather I can say, prepare your balance sheets with two heads called reserves and surplus. So the profit and loss account is a surplus, not a reserve. As per as the Companies Act is very clear, pre-reserve doesn't include the surplus. Pre-reserve means a reserve from which you can declare dividend. And it says so and so and so, like revaluation reserve, this reserve, notional reserve that you have added, remove it. Any carrying asset, adjustment to the asset or liability, remove it. So reserve, please in mind, pre-reserve. But here, the outstanding balance of pre-annual account. Now creation of pre-reserve, what is that? General reserve is not a mandatory, isn't it? Correct? No, it is not a mandatory as per New Companies Act. Earlier there was a table, if you declare dividend this much, 5%, 15%, like that is. Now no such mandate requirement. It is up to the company to declare, transfer the money to the reserves. So this is the definition. Now you go to the section 2, which is a definition section. It says, unless the context otherwise requires, the following definition should be applied. Now you need to understand contextual interpretation of a particular phrase. This is the pre-reserve phrase. Now, can I extend the pre-reserve under this particular thing, including profit and loss account, is a debatable question. Not only for this, there is even borrowing limits, 186 and also 181 limits by the government, board and all. Whether pre-reserve is included or not. Similarly, section 68 with respect to the buyback, they also use the word pre-reserve, and that pre-reserve as per buyback includes the even security premium account also. The explanation provided in 68 under, they're also there. So be careful. So you can't simply presume that my accumulated profit is a pre-reserve. We have made representation before the ministry. They said, no, we want to treat separately. Profit and loss account treatment separately, this treatment separately. They say profit and loss account, yes, it is available for dividend, because the dividend 123 uses the word profit of the current year, previous year, accumulated, this, everything is there. Profit only they use word. In all other sections, they use word pre-reserves. So you may get a notice tomorrow from ROC, we don't know. If you have considered, like example, recently one case, buyback case. They have gone with considering the profit and loss account and declared the buyback and given money. ROC issue notice. And literal meaning you take, it is not included. But you see the essence. Why the profit and loss account? Sorry, this security premium also is considered to be pre-reserve. Cannot be. So we have to argue. Should take the help of some case laws. Now, as per the new act, no case law. So that is the one. Here, whether pre-reserves includes the security premium, this one is there or not, God only knows. So you have to take a call. If you are taking a call, be very clear. What is that you want? How much? Because my 100% only. That means 1:1. Your debt equity ratio is allowed through the deposit. That is objectivity of this particular. Allowing 100%. 1:1 only debt equity. If you are a private limited company, that is a 1:1. Then another category is called startup. Startup company, the 5 years, it can take any money. Any money. There is no problem. Unlimited. Then go to another country, which will 3 category, which fulfills the following category called, it is not, it means a standalone, a private company is defined here. Standalone private company means is not an associate, not in a subsidiary, not in a holding of any other company. So in this company, no other company has invested, or this company has not invested anywhere. Standalone. A standalone private limited company, and it has borrowings. They are allowing borrowings from the banks and other body corporate. They can borrow up to 1:1, twice the capital, up to twice the paid up capital. In fact, it is not even net worth. They use only paid up capital. Twice, not even the pre-reserves and security premium account. No. As far as the shareholders are concerned, they say 100%. When you are borrowing from the bank and financial institution, they say up to the paid up capital, twice the paid up capital. Suppose I've seen many companies having only 1 lakh paid up capital. How much you can borrow from banks to get exemption? Maximum 2 lakhs you can take. So you will not fall into this category. Pre-reserves are not included. Security premium is not included to borrow. Only paid up. So that much is the paid up. Such borrowing, again, there should not be any default that subsist. Default should not have been there. And they say the money not exceeding 50 crores. That means to borrow or to be eligible under this category, your paid up capital minimum 25 crores should be there. Then only you can borrow 50 crores. Correct, na? So that is the very, if you have got this category, you can borrow whatever that you want. 100% is not applicable. Because 100% is there A only. A says plainly you can go 100%. So and so. Then startup company, we can take whatever the money he wants. The next one, up to that twice. So it is the money should be only from members. Be remember, not from outsiders. Only from members. Only from members. Yes, they have given clearly startup as per DIPP only. 10 years only. Yeah. See, there is a one very draconian provision that generally we don't observe. Under the exemption notification released on 5th June 2015 to all categories companies, including private companies, Section 8 company or Nidhi company or government company, they have added one statement. All those exemptions or modifications, everything will be available if you are filing your annual return and balance sheet in time. If you are filing your balance sheet in time, if there is a default over, all those exemptions are withdrawn. All those exemptions are withdrawn. Not only deposit exemption, like quorum, whatever it is that you feel, all will be withdrawn. All will not be available. So bear in mind. So balance sheet should be filed. If you want to avail any of the exemption under the 5th June 2015 circular, you need to be compliant company, being a private company. Then only you will get, otherwise you cannot get that. It is clear that second statement, if you go to the table, under the table, they have made statement 1 and statement 2. Statement 1 says that, statement 1 also should be explained here. Statement 1 says, in the top you say 1 or 2, that is explanatory statement for businesses. Special business is not applicable, like that is written. However, in the below the table, first statement says, while availing those exemptions or adaptation, modifications, the private company should ensure the interest of the member is properly taken care. Now tell me how the member's interest is properly taken care. Now you have gone for a private placement. Now you are taking a stand that 102 is not applicable. So I will not disclose anything under the 102, that is explanatory statement. Is it correct view? So that means even though 102 exemption is available, but to take the interest of your members, to make your members informed decision, you don't have any option. Wherever the explanatory statement says clearly these things should be there, like private placement offer letter, preferential offer letter, all other places, you need to make a disclosure, though 102 is not applicable to a private company. So very important, those statements made under the table, go and have a watch one more time. Yeah, very good point. Yes. See, if you interpret the default, how default comes? The default comes if you file any document after due date. Okay, but default rectified in your case. Since you filed, no? Filed. Very good point. There is another provision under section 454 subsection 3 and proviso they have added. In case of balance sheet, in case of annual return, if the return is already filed, no prosecution, no penal provision, no adjudication, nothing. See, all adjudications are concluded. They have written that word. That means default is concluded. That means if you file return with due date or after due date with additional fees, you will come back to the normalcy and you will be enjoying all the exemptions. That should be, I feel, correct interpretation. Otherwise, one time and you are debarring lifelong, it's not correct. That is, intention is not like way. Okay. And you are giving other way, it is not a default. Once you pay the 100 rupees penalty daily, over. I will not prosecute you. They are giving clearly. That means there is no default deemed. That means default, subsist of default is a default as per my understanding. Subsisting of default is a default. Concluded default is not a default as per the section, 92 and section 137. That means not for all other sections. I am giving only for these two sections. Read with the 454, that is adjudication process, subsection 2, they have added one provision. With that provision, I am just giving this clarification. But all other sections I cannot tell, because ROC can, like MGT 14 is delay filing, ROC can certainly take chance of rising adjudication, because that is not excluded, that is not added in this provision. Only two sections are added. So that is 92 and 137. So I feel you are correct. Once you file the forms, then you will, position is restored, so you will continue to take the exemptions. Yeah. INC 28 under which section? 22. 22, 20A, sorry. Yeah. Yes. Correct. There are two components in it. Bringing money within 180 days and filing the form. Two components are there. Both should happen within 180 days time. And in your case, if money has been there in the bank account within 180 days, but filing is delayed, it may not be seriously looked into. Because there is a section 248. If you don't bring the money within 180 days and don't file the form, two conditions, then ROC may strike off your name, company name. That additional ground they have added. That means both. So there is a probability, if you have brought the money but filing is delayed, that's okay. I feel that is only not completely non-compliance. But in your case, money itself is not brought in, and money was brought in and then return was filed, and both are after 180 days, and ROC is taking very much serious, and they are going for adjudication process only, not striking up the name of the company. Adjudication process, I think, very draconian. Again, that is I think section 10, 11, 10A, 11A, no? 10A, yeah. So that the violation of 10A, I think some few lakhs will come. Recently, one case, I think 3 lakhs were imposed. The company is only 1 lakh capital. Where they will go? Then they appeal to the regional director. Regional director has reduced drastically. Say, how company will survive? A 1 lakh company, if you impose 3 lakhs, how will they survive? you should go for an appeal, then they will reduce it. They will, because ROC has no power to levy less than the minimum penalty, all entire sections. So that is a problem. Yeah, I'm not getting to details. So to accept the private company, money, I told only one resolution should be passed, then you take the money, and the money should be as per the 3 years only. You cannot take unlimited period. There should be deposit, kind of receipt should be issued, and you should recognize as a liability in your books as separately deposit. And similarly, there should be something that you maintain the data bank as a deposit. So document should be there. You simply just have a book entry, you cannot say that is not permitted, and 3 years only maximum. If it is from members, 3 years you have to take, not beyond that. After 3 years, you should renew it with the consent, their consent. And DPT3 should be filed for everything. And other things I told, depositories, maintenance of register, reporting at a board report and financial statement, all are must. You need to report it. Punishment. Let us know the bad before we move into another slide. See, look at this. There is a 76A. In fact, this was a miss out. It was not there in the original in the Companies Act. It was afterthought. Recently they amended. It was not at all there. No penalty was there. So we were falling into 450 general penalty, which is just 1,000, 10,000 and 1,000 for every day. So now they brought in, this is the 76A. So they say clearly, if you violate, fail to, do it, it is like minimum fine. In addition to the repayment of the money, you should repay it along with the interest, and a fine of not less than 1 crore or twice the amount of deposit accepted. Means 1 crore or the twice of the amount deposited, whichever is lower. Okay, but the money may extend, that is upper limit, it may go to 10 crores also. Very draconian. That is one aspect as far as the money is concerned. Go to the next, and they have used it work. So it is not compoundable offense. You can't go under compounding 441 is not allowed. It says every officer who is in default punishable with imprisonment, which may extend to 7 years, and fine, and which shall not be less than 25 lakhs, but which may extend to 2 crore. So very draconian. So anything that you violate relating to the 73 to 76, including deposit rule, this is the only section, because it says clearly, the section starts with for violation of the section, rule, rate, so on, so it's written. See the first line, if you read, no contravention in the manner, conditions prescribed under the section 73 or 76 are rules made thereunder. So entire 76 rules also covered under this only for penal provision. And if it officer is found to be guilty, that means mens rea. If there is a mens rea, purposefully you have done, then it is a 447, that is a fraud. So mens rea is proved, then it is considered to be fraud, and fraud will be as per IBC, what is that, in an Indian Penal Code, there is separate treatment is there in addition to Companies Act. So separate treatment, maybe treatment plant is different there. So we have done with the deposits. I hope I could clear something what, here and there, what I learned from my research. So it will help you. So we'll move. What is the time now where we are standing, whether we got some time, some 10 minutes only is left, I believe. Okay. So I hope I did some justice to subject. If I rush through, I don't think you can do justice to subject. And moreover, this is a very current subject, and you have balance sheets around the corner, TPT3 around the corner to prepare and file. So we will rush through the other sections also. Maybe if you are not much hungry, then we may extend little 10-15 minutes. So I will try to put the things in what I understood. As I was an accountant for 5 years before I became a company secretary. So some accounting knowledge helps me to understand the provisions. So I'll put into that commercial sense only. Let me go to the 179, 186 and 185 and 186. How the sections are framed like this. See which one is broader in sense. That means what are the transactions covered in which section? Like you take this, that yellow is a big circle. All transactions will fall into the 179. That means giving loan, anything for that matter, irrespective of the recipient. Irrespective of the recipient, all types of loans or advances, guarantees, investments. Four you should remember, 4 words. Loan, advance, guarantee, investment and security. all four will fall into the invariably under 179 subsection 3. What is that 179 subsection 3? What is that? That section says that should happen only at the board meeting. That means you cannot pass a circular resolution. So that you should keep in mind. Why I am just drawing the 179.3 is that cannot be through a circular meeting. Circular resolution should be through a meeting. However, meeting can be through video conferencing. That is allowed. Okay, that is a requirement of the 179.3. However, if you go to the 179.3, if the transaction do not fall, if the transactions do not fall into the 186 and 185, that you can delegate to some officer. Got my point? If the transaction do not fall under the 185 and 186, you can delegate to the committee of directors. You can delegate to the managing director. You can delegate to the executive director. You can delegate to the principal officer. You can delegate to the branch head. That is allowed. But you should decide how much you can do, where and all you can invest, what and all investment securities you can invest, or how you can give guarantee security. You should define clearly. So what is the requirement of 179.3? One is to happen at board meeting. And if the transaction other than 186 and 185, then that can be delegated to the some committee with a clear indication what and all they should do it. So that is a requirement of the 179. Even including board committees also can be delegated. There is no problem. So now that 186 is the, so whatever the transaction that fall under 185 will invariably fall under 186 and invariably fall under 179 also. So 179 is a bigger thing. That means the transaction should happen at board meeting only. That you should remember. We will now look at this. It will give you some idea. So rain is falling. Rain is falling automatically from 179 directly. It is not going to the next circle called 186. It is not going to the another circle called 186, 185 also. But the rain which is going through, passing through the 185, it should invariably pass through the 186. It should invariably go through the 179 as well. Like giving one example, investment. You are investing in the bank FD. It is a pure 179 subsection 3 transaction. That means you can pass a resolution, but resolution should be at board meeting only, but you can delegate it to someone else. So from time to time, you can delegate it. Because it doesn't fall under 186, doesn't fall under 185 as well, isn't it? Okay, so that you should remember. So 185, 179 is a bigger circle. Over that 186 will come, and over that 185 will come. So mere getting the approval under 185 is not sufficient for a related party loan. You should also satisfy the 170, 186 as well, and 179 subsection 3. That means should happen at board meeting alone. I'll take you next level. See, as far as the 185 concern, there are, you can broadly categorize, there are 3 types of transaction as per subsection 1 and subsection 2 and subsection 3 of the 185 redrafted section. I'm not going with the old section, redrafted section. As far as subsection 1 is concerned, it is a prohibited transaction. You can't do it. Once it is prohibited at 185, certainly it can't do it 186. You can't do certainly at 179.3 also. Can't do it. Like example, giving a loan to a director in a public limited company. Prohibited. Prohibited. Maybe your income tax will levy the deemed dividend. It doesn't matter. But here it is prohibited. Again, that 185 is again little draconian section as far as the penalties are concerned. The minimum penalty is 5 lakhs. The maximum penalty goes up to 25 lakhs per company, per individual who is there in the transaction, and the directors also. That means officer in default. So all 3 people will be each 5 lakhs, it will go to 25 lakhs. And before that, you should rectify the offense. Means you should get back the money with interest. Okay, that is the requirement of that. So there are prohibited transactions as far as 185 is concerned. And the next one is the regulated transactions. Regulated means they are allowing, okay, What is prohibited? I will tell you. Generally, they have prohibited any person intended transaction. Like you are giving loan to director, loan giving to the relative of director, loan giving to a partnership firm where director is a partner, a relative is a partner, or a there are some other like a holding company director is there, for him also we are giving a loan. All these prohibited. Okay. So restriction means you get the shareholders permission and you give it. They say between body corporates where director is interested, maybe as a director, maybe as a member, you can give it. But get a resolution, special resolution passed by the shareholder. The resolution should be executive resolution. That means it should speak all the terms and full particulars of terms and conditions. What generally you incorporate in your agreement, loan agreement should be incorporated there. And that resolution should be prior approval. It's not subsequent approval. Because if you look at those clauses in that explanatory statement you are supposed to disclose, it says the purpose for which the loan is granted and that company which is going. See, there is a probability you take the money from A to B and there you may siphon it off. No. So that they want to prevent. It says the company B should use only for its principal business purpose. It may be for main object purpose or it may be for the incidental activity to the main object. Both are allowed. So it should use, it should not lend further to someone else unless it is NBFC. NBFC can do it. So all other companies, their main object is not to lend the money. No, is it to lend the main money? No. So they don't want to further pilferage the money from the other company, like routing through that is not allowed. So subsection 2 of the 185 says clearly, wherever directors are interested, till you can give the loan. But get a shareholders resolution passed, file the MGT 14, then route through the transaction with 186 and board resolution. I will tell you how it goes. So you can do it. As far as the allowed transaction, that is exempted transactions are concerned, they say if you are giving loan to a wholly owned subsidiary, give it. There is no problem. If you are giving guarantee security to the other than wholly owned subsidiary, give it, no problem. You are giving a loan to a director, managing director or whole-time director as a employment policy, like every employee is given, okay, give it, no problem. And if you are giving a loan to a director, not through the employee policy, by passing a special resolution, having a scheme to give to the directors, whole-time director, managing director, give it, no problem. But regular director cannot be given. Only executive directors, managing director, whole-time director can be given. To give that, you should ensure that you are in the company, your director is designated in the company's MCS site as an executive director. No, I will tell you that exemption is there for standalone private limited company, not for the all other companies. Okay. And another exemption is there if your business itself is giving a loan like NBFC. There is some criteria is there like yield rate, how much rate of interest, at arm's length price, ordinary course of so and so. If you are giving, then that is allowed. So there is no problem. So what is prohibited, you can't circumvent. That's what the subsection 2 and 3 says clearly, but they should use only for their principal business purpose. So that is all about 185. I'm not getting to too much. I have so much to speak on 185. I don't want to get in. This is the sum and substance of the 185. So you have prohibited transaction, you have regulated transaction, you have exempted transactions. And as we have seen deposit rule, like paid up share capital is not twice the borrowing is. So no, a private company, which is a standalone private company, no other company has invested. That means it is not a subsidiary of some other company, no associate company, it is not a holding subsidiary, all those things. A standalone company which has a borrowing up to 50 crores, either from banks or financial institution, 50 crores or twice the paid up capital. That company, if there is no default subsist, they can give a loan to the subclass 1. I told not to prohibit it to the director and relatives under. You can give it. That circular was issued under the old section, 213, prior to the 7th May 2018. But there are plenty of questions whether the circular is valid or not. But I say the circular is given under, I think, 462 in the public interest. They have said clearly, in the interest of any class of companies, central government can exempt all or any provisions of this particular act. So the circular, the exemption notification is not given under the old 185, power using under old 185. They have given under general power. So that is valid. Circular is valid. Even section is substituted also. There is no problem. Now because even regular companies can give no for anyone except directors. So that is allowed. So circular is valid. I am not giving to this journey that I told no. Prohibited basket is there. You have regulated basket and then permitted basket, which I have already explained to you. Prohibited, I told you, blanket ban. Whom and all you cannot give. You cannot give a director of your company, director of holding company, partner, relative of a such director or firm. Can't give. There is a one concept that you should remember. They have used in the to 185. 1 minute. Public, what is that? Including by way of book debts. They have used word including by way of book debts. Loan in the by way of book debts. So loan representing, see the first line, including any loan represented by a book debt. It is a debatable subject under section 296 of the old act. There was a separate section, is a lot of judgments are there. A loan representing by way of a book debts. So the instance of giving money is not to supply and goods. You just given a color saying that you are getting some supplies from him and you given him. You never ever got the supply from him. Ultimately, he had repaid the money. Like one example, you give a foreign travel advance to director. The director doesn't have in passport also. And you say after 5 months, 5 months, he will refund it. And so this will continue to hold it in your books as a debt, book debt. So those nature of transactions subject to the facts of the case will also be considered as a prohibited transactions. That is the essence of the book debt. Yeah, there are so many judgments. I don't want to get into the yeah, few companies they are exempted. I was telling to know private limited company where there is no investment in it by any other body corporate, 50 crores, twice the paid up capital, whichever is there, no default substitutes. Private company can give a loan to the director, loan to the member, loan to the shareholders, anyone they can give, no problem. Nidhi company, again, because the purpose of Nidhi company to give a loan to members only. So that is exempted. Government company also can give a loan to directors, but government should agree. Administrative ministry should agree for that loan to directors. As I told you, it is a 5 lakhs minimum, 25 lakhs, and officer in default also the same, and the person who has taken the money also the same. So all should apply for the compounding if they want to go. It is a compoundable section, but compounding can happen only after rectification. You recover that money with interest and you go for a compounding. There are some questions are there, like trust. Can I give a loan to trust? The question. Can I give a loan to LLP? Because LLP is not there in subsection 1, means in the prohibited list, LLP is not there, only firm is used. Firm is different from LLP is different. And in the regulated transaction, they use body corporate. Whether my LLP will come body corporate, it says voting power, where in meeting you will vote, then only like that. So body corporate has a qualified words there. LLP doesn't satisfy those qualified words. So there issues are there. Can I give a loan to trust? See, we have to see the Companies Act. There is a one section 166 duties of directors. In one of the subsections, there is clearly the conflict of interest, and director should be away from the conflict of interest. So considering that if it is a private trust, director is the what is the beneficial owner, or his family is a beneficiary, in the private trust. Certainly, I don't suggest to giving a loan. It is as good as individual, because trust has no legal entity. No, you are giving loan to individuals only, so it is prohibited. So you have to interpret the way, especially 185 and 186. No, better to go with a conservative view of interpretation rather taking very aggressive steps and all. That is, I feel, not permitted. So you may, but you will fight. You will go to the court only. Yeah, 186 subsection 1, as I already told you, it is a layers. How many layers you can invest? If you have a complexity of companies having like subsidiary on subsidiary, subsidiary on subsidiary. It is why they want to prohibit the layer is only to prohibit the filterage of the fund, subsidiary, and at the end we don't know what is happening at the subsidiary level, and sometimes they will avoid the consolidation also. So that is exactly the intention of this particular layer rule, and up to 2 layers you can have it. So beyond that, that is not permitted. Only foreign company you acquire a foreign company having so many layers, that is allowed. And you are getting company incorporated because of some legal obligation, that is also allowed. It is going to be one more layer, no problem. Excluding that, all other companies are there. And there is another problem with that. They have defined the investment company not only having an object of investment company based on its assets, based on their net worth and income. You will deem to be investment company. Then that time you will come to this, this layer rule, you will violate the layer rule. What is the problem? Okay, I violate the layer rule. What is the problem? As per the subsection 12, I think, this section is not compoundable. 3 years imprisonment directly, and you need to go to the court of law. Imprisonment is a mandatory. So that way they lock the section. If you violate the section, imprisonment, in addition to the penal provision, 3 years imprisonment is there. And recently ROC has issued notice for many directors. They can easily find this. It's not a big deal. The XBRL data easily they can identify all the flaws that you have in the system. So that is a problem. The section is not compoundable, very draconian section. So you can't go for compounding. You have to go fight before the courts only. That is special courts. I'm not going these layers. Yeah, this is again, I've already explained you, investment company. I'm not going to this. Yeah, subsection 2 is a new policy, as I told you, that how much you can take away from the company, though your object is not to give a loan or guarantee security. Correct? Na? See, this section is not only, it's just not to the NBFC companies, all companies. They say board can take out 60% of paid up capital, pre-reserves and security premium account, give to someone else. It may be a person, it may be in body corporate also. 60% is allowed straight away. No shareholders approval. That is exactly this section. And if you want to give more than the 60%, 60% of what? Paid up capital, pre-reserves and security premium. Equivalent to what? 4 items. One is the loan, guarantee, security, investment. All 4 together. If you club all 4 together, it should not cross 60%. Or 100% of paid up capital and pre-reserve. 100% of what is that? Pre-reserves and security premium account. That much you can give. Means board can take out complete whatever they earn money. It may be in terms of pre-reserves, it may be in terms of security premium account. They can drain out from the company. That is allowed. The only one check in it. Subsection 5 should be read. It should be read properly. It is nothing to do with 179 subsection 3. In this subsection, they made every director is accountable. Whoever present at the meeting, he should raise his voice. It says unanimous consent of all the directors. Whatever you do, and that particular subsection is a transaction subsection. It's not that fixing the limit. It's written no loan can be given. So it is different from subsection 2. Subsection 2 gives a limit how much you can give. How to give it is written in subsection 5. Clearly, no loan can be given, no guarantee can be given, no security can be given. That means every transaction should be routed through the board. That too, entire board member, whoever present on that meeting, should approve the transaction. No denial, no disinterested. If someone says that I am not approving, then you can't give a loan. So while minuting, I don't know how far it is, we are minuting, but you should minute it clearly. ROC looks at only your minutes. And tomorrow there is one section, like section 149, subsection 12. If any director want to escape, if director in any board process, he comes to know that there is a violation, he is also responsible through board process. Even though he is not a party, I told director present at the meeting should unanimously approve the transaction. So one director purposefully, knowingly, he doesn't present on that day. He doesn't want to oppose it, the transaction. He doesn't present. This is applicable to private companies also. Bear in mind, it's not only public limited company, private companies also. If you get any director opposing who is not present at meeting, he may oppose it. If he doesn't oppose the board meeting or board circulation agenda and all, he doesn't oppose, he doesn't present, he is held under section 149 subsection 12. That means through his consent, invariable consent, because he didn't come to the meeting, he doesn't want to say yes, so he will be caught there. So 186 subsection 5 is very crucial, but board can give with unanimous approval as long as there is no default with the banks and financial institution. When there is a default, how you will give? You can't give. If there is a default, you have to get their prior consent also. Financial institution prior consent is required. Up to what extent? 60% or 100% only their prior consent is needed if there is a default. If you are crossing the 60%, 100%, whether there is a default or not, their consent is needed. Public bank and public financial institution, not any other body corporate borrowing. Yes. Yes, yes. If it is the entire aggregate loan guarantee security is more than 60% or 100%, whatever the limits in subsection 2, if you are crossing that, whether default subsist or not, you are supposed to get their prior approval. But no one is doing. But big companies, they have their own checks and balances. Should be very careful this. This is again, I told you, unanimous consent and prior approval. If you don't get prior approval, certainly the case may lead to the IBC also. You defaulted, you siphoned the money. And our entire director, board member, everyone is given a security for that. They say, okay. So subsection 5 requires, subsection 4 of that particular section 186 requires disclosure of the particulars of the loan in the financial statements. Financial statement, they use the word. And it's justification. Why you are given the money? Justification should be given. Then other thing, if we go to the 134 with respect to the board report disclosure, they also say at the board report, again you should make a disclosure of the transactions happened under 186. Maybe you can, if you are given full disclosure at the notes to the accounts, you can refer in the board report. You can say yes, as per the swans. Because on one of the subsections at the board report 134 says, if you have made disclosure somewhere else, you don't need repeat it, simply refer it. But making board report with that reference is a mandatory. Making disclosure there, it is a mandatory. You can't make a reference at the notes on account saying that I made a disclosure at the board report, because accounts will be ready first, not board report ready first. No, correct? No, accounts should be ready first. Board report is after the audit report will prepare. So you can't make a cross reference to the board report, whereas you can make a cross reference to the notes to accounts. That is allowed. So that is very, again, even you give a loan as per 185, there are certain prohibited transactions, there are certain regulated transactions, there are certain exempted transactions. Even in all the exempted transactions, as I told you, should be routed through 186. Interest is must if it is a loan. Subsection 7, there is no exemption. Look at the subsection 7 of 186, no exemption. Of course, they are given the rate is as per government yield for 3 years, 4 years, 5 years, 10 years. Government yield rate is very nominal rate. At least that rate should be minimum charged. Rate, without rate, I told you, 186 violation will come. Gone. People will be put in jail only. That is the draconian of that section. So interest rate for all exempted transaction, all regulated transaction, all prohibited transaction is a must. It may be an individual, it may be a body corporate, it may be subsidiary, it may be an associate, it doesn't matter. No exception. You can have 100 things in your agreement. An agreement cannot override the act. Look at the section 6, which says act overrides all your MOA, all your AOA, all your agreements, all your board resolution, all your shareholders resolution. So 186 subsection 6 is a very draconian subsection in your entire 186. Very draconian. One I told 186. 5, that is a board meeting. All directors should accept it. That is a one. The second one is the interest rate. I have seen many companies all violating. Fortunately, under subsection 11, there are certain exemptions. Exemptions are differently, like a category wise exemptions are there. If you are a category, certain category of companies like infrastructure. What is infrastructure company? They have defined in the schedule. In the schedule, real estate company will come. So all real estate companies are exempted from the compliance of 186 entire section. However, subsection 1 layer is applicable. Subsection 2 onwards, balance sections are exempted for that class of companies. Similarly, investment companies making investment as per RBI rule, they are exempted. Like some exemptions are there, like you invest in the rights issue. Suppose you are a shareholder, being a company, you are also shareholder, some other company, they gave an offer, you don't have limits. Can I subscribe to the shares? Yes, you can subscribe even though you don't have limits. That means board can go beyond 60% at that particular point of time. Like that, transaction wise some exemptions are there. So one should be very careful with 186, very draconian section. So yeah, present at meeting. That's what I told you. Which can be delegated, which do not fall under 186, 185. Those, I told one example of bank borrow, bank FD. That much, you can't delegate anything. This is more powerful than 180. 180 is, why I'm just using the interpretation called specific versus general. It is very specific. Giving a loan to, yeah, that's why bank FD is a general in nature. Okay, so that is allowed. Why FD? Why not? Why the FD is not considered to be loan? Because this 186 they use word loan. Are you giving loan to company bank by placing FD? Are you giving loan to the bank by placing FD? So one should know what is the difference between a deposit and the loan. So there is a Supreme Court judgment on this. Deposit, the person goes and invests his money. Okay, whereas loan, the lender will not come to you. See, in deposit case, technically it's your money. You are going and placing it there. Whereas in case of loan, the person who needs money, he walks into the bank. So that is a major difference. You have surplus money, you want to have interest. Bank is not interested in your money. They may put some board, we are accepting deposits, and that is not invitation. You are inviting. Who is inviting? The person who has money is inviting to the bank. Yes, I am placing this 6 months, 1 year. So that is the reason the deposit is not a loan under 186 purpose. So it doesn't fall under the 170 subsection 5. So no unanimous resolution is needed. So almost all treasury operations, where government securities, because government is not a body corporate. Another thing that you need to understand, that my friend told, these securities, they are defined under the SCRA 2H class. Now Companies Act refers only that. In this particular unfortunate drafting of this particular or fortunate drafting, I'll show you what it is. Yeah, you read the third bullet. So this section is applicable when you compare the what kind of investment this section is applicable. Suppose I am investing into LLP. Is it a 186 transaction? Straight away the answer is no. So you can pass 170 resolution and you can invest it. Reason is that though section uses the word investment, all those stuff, so the very funnily they are drafted, acquiring by way of subscription, purchase or otherwise the securities of any other body corporate. Only you have investment option plenty. Correct? Now you have plenty of investment. You can invest in the mutual funds, you can invest in securities, you can invest in the FDs, you can give, you can invest in the partnership firm, you can invest in the LLP. All investments are not covered. They say only securities. Okay. Securities also as per definition, they say this. The securities again, what kind of securities? It is a qualified word. They say securities of other body corporate. Only that much is covered under this section. Securities of a body corporate. So the person who is giving the issuing security should be a body corporate. LLP, though is a body corporate, LLP cannot issue securities. As per LLP Act, there is no concept of securities. Of course, there is a proposal in the LLP proposed amendment that NCD, non-convertible debentures, can be issued by LLP. They are envisaged till date. So till date, investment in the LLP or investment in the partnership firm is not covered under 186. So one should be careful about Yeah. Yes, I will. Yes. Mutual funds. Generally, mutual funds are issued by a trust. But there are few exceptions are there, like UTI. UTI is a body corporate. And mutual fund is as per the definition of 2H of SCRA clause, is a security. Now, it qualifies both. Security of a body corporate. Mutual fund is a security and issued by a UTI. UTI is a body corporate. So, mutual fund, you are investing in the UTI or any other body corporate which are giving directly, that is covered again here. Suppose in general you invest in mutual fund, that is not covered because it is a security but not given by a, not issued by a body corporate. So that is the difference, prime difference between they have not used word investment, which is used in 179, to invest the funds, that is the 179(3) uses. Here they are not said, he says acquiring by way of subscription, purchase or otherwise the securities of any other body corporate. So both conditions should be satisfied. It should be security and to be given by a body corporate. Then only this section gets attracted. Otherwise 179, straight away board resolution, unanimous approval is there or not, you delegate the power to give a committee, all those things are allowed. Yeah. No, as per the Nidhi deposit rule, Nidhi rules, no, advertisement is not permitted. Only you can advertise your notice board. You can advertise in the website of your company, means in the Nidhi company, and you can advertise in your branches. There is a display board, like you go to a bank, no, you walk in the bank, you will find 6 months, 3 months, 9 months, 1 year, 5 year FD rates. That much you can do. But website only rates, no invitation. No, that's what invitation is not required. Yeah, we will close now. It is lunch time. Whether you are hungry, I am hungry. Okay, so I'm just closing down. So I just focus what I learned. So many things are there. So many practical things we can explain. But I'm not questioning the time and all. It is a time that is scheduled. Whatever I'm able to do it, I could do it. So if you got any question, any answers, another 5 minutes as usual, we can discuss. Otherwise we can close. I will leave this presentation to you. Maybe you can make use of it to understand. Yeah, this is the penal section, which I told 25, minimum is 25,000. It may go to the 5 lakhs and defaulter up to 2 years and fine 25 and 1 lakh. So the section is non-compoundable. And if there is any intentional violation, then it will go to section 441. That is a fraud under IPC also. So that's very draconian. So one should be very careful. ROC can find easily the non-compliances. And the auditor is supposed to make in the annexure one of the paras here clearly, like parties covered under section 189. There are loans, guarantee securities, this. And you are already giving a certificate. But you should say, see, if you look at your own audit report, is a compliance certificate. Look at every word of your certificate is a given complied. So you are also ensuring the compliance. And if you don't ensure the interest rate, you should certainly say company has not complied. Why you want to take someone's responsibility on your head and endorse that, saying that he has complied? I feel one should say clearly not complied. interest rate is not charged, subsection 7 of the 186 is not complied. Over. I've seen many companies, they charge the interest rate. So due to some condition, they say you waive it off also. Companies also waiving off. There is no provision to waive it off also. So no provision to waive it off. Okay, we'll conclude it. Thank you very much for making me to understand further. You only made me to read this section further. So I should thank you. How much I could convey, I don't know, but I could try to convey whatever it is. So I thank you very much to keep me awake, and you are interacted. It's not that you, so many questions were there and I could answer whatever I can. So thank you very much for the Bangalore branch of ICAI for giving an opportunity to enhance my knowledge. Thank you very much.
Thank you, Thirupal sir. Yeah, thank you, members. I hereby thank Mr. Thirupal sir for putting the discourse of Companies Act before you with regard to loans, advances, deposits, and all. May I request Prakashan sir, Chairman of Bangalore branch, past Chairman of Bangalore branch, to present a gift voucher to Mr. Thirupal sir. Yeah. Thank you, members. We will reassemble sharp at 2:30 post lunch. Thank you all.